In recent years, investing in U.S. bonds, both government and corporate, has been a good idea. However, the unusual length and depth of the Fed's rate hike cycle since 2021 have extended the realization time for these positions more than expected, but it has not changed their return prospects. Moreover, the debate in the U.S. Congress about the need to raise the government debt ceiling has opened a new window of opportunity for those who missed it in the past. Financial media is full of alarmist misinformation about the U.S. government's debt ceiling debate and the resulting interest rate hike on Treasury bonds. Media headlines repeat almost every day that if Congress does not raise the debt ceiling, the Treasury will run out of money. The United States will default on its debt. Markets and the economy will collapse. However, even a superficial examination of American history shows that the issue of the debt ceiling is not only a non-crisis but also an opportunity to buy bonds. To understand why, let's first ask ourselves this question: have the United States ever defaulted on its debt in its history? The answer is yes. It happened only once, when investors in Treasury bonds due on April 26, 1979, were told that the U.S. Treasury could not repay those bonds on the scheduled due date. The Treasury, reasonably, blamed Congress's failure to act promptly to raise the debt ceiling for the delay. So at least once in its history, the U.S. Congress reached the limit so feared by today's media, namely, it failed to agree on the debt ceiling, causing a default on Treasury bonds. But at this point, we must specify that that time was a very particular default. For Treasury bonds, there are two types of defaults. Actual default, in which the debtor, i.e., the Treasury, does not have the money to repay the capital owed to its creditors. Technical default, which is what happened in 1979, in which the Treasury has the money to repay the bonds but cannot do so because it has not received permission from the government, still stuck in the debt ceiling debate. So in this second type of default, the Treasury must wait for Congress to resolve before paying off the debt. It's not that it doesn't have the money to pay it. So even today, there is a remote possibility that this isolated incident could recur. But the crisis that bond investors might face in this case would be a technical default, not an actual one. In summary, could there be a short-term delay in interest payments by the Treasury? Yes, there is a low probability that this could happen. Is there a risk that the interest or capital of Treasury bonds may never be repaid by the Treasury? Absolutely not. Since 1960, Congress has approved a permanent increase or temporary extension of the debt ceiling or a revision of the debt ceiling 78 times to date. It has happened 49 times under Republican presidents and 29 times under Democratic presidents. So just like the other times, Congress will eventually raise the debt ceiling again. However, we can be sure that it will not do so without staging the usual dramas, with both parties pointing fingers at each other before reaching an agreement. And there is also a remote possibility, which happened only once in history, that these bickering will delay the payment of interest on bonds with close maturity dates. But nothing more. Therefore, bond investors should welcome the debt ceiling debate instead of being alarmed by the media. Despite the recent volatility in the bond market due to the uncertainty surrounding the debt ceiling debate, there are still many reasons to be optimistic about the future of bond investments. First, bonds are still one of the most reliable ways to generate income in a portfolio, particularly for retirees or those with a low risk tolerance. Second, bonds can be a good hedge against inflation. Inflation occurs when the general price level of goods and services in an economy increases over time, reducing the purchasing power of currency. Inflation can have a significant impact on investments because it erodes the value of returns over time. However, bonds can be a good hedge against inflation because they typically pay a fixed rate of interest, which means that their returns may increase in real terms during times of inflation. This can help protect investors' purchasing power and make bonds a more attractive investment option during inflationary periods. Overall, bonds can be an important part of a well-diversified investment portfolio because of their potential for generating income, reducing portfolio volatility, and acting as a hedge against inflation. However, it's important to note that not all bonds are created equal and that investors should carefully consider factors such as credit quality, interest rate risk, and duration before making investment decisions. Additionally, like any investment, bonds come with their own risks, and investors should be prepared to weather market fluctuations and potential losses. As always, it's a good idea to consult with a financial advisor or do thorough research before making any investment decisions. Thanks for watching my video.